Welcome to Stock Market Today, your market briefing delivering actionable insights on stocks, bonds, crypto, and the macro events that will move markets. Let's cut straight to what matters. Treasury yields just blew through critical resistance, and tech stocks are feeling the pain. The 10-year Treasury hit 4.29% in early February, breaking key psychological barriers that held for months. According to Wedbush analysis published February 5th, this isn't just noise. It's a technical breakout signaling a fundamental shift in how markets price risk-free returns versus growth assets. Here's what's driving this move. On February 2nd, the 10-year passed 4.27%, while the 30-year climbed to 4.90%. That's a bear steepening of the curve, long rates rising faster than short rates, driven by recalibrated inflation expectations and fears of extended Fed tightness. CNBC reported the 10-year retreated slightly to 4.235% on January 29th, down about 1 basis point. But the elevated baseline remains the story. The Federal Reserve is holding rates at 3.5 to 3.75% as of their January 29th meeting. But the communication tone has turned decisively hawkish. The market is no longer pricing in aggressive rate cuts. Instead, traders face the reality of an extended hold or even potential tightening if inflation stays sticky. Data suggests inflation could linger near 3.4% in Q1 2026. Tight labor markets are feeding wage pressures, giving the Fed zero room to ease policy. Governor Waller recently advocated for just a modest 25 basis point cut, highlighting internal Fed debate about the path forward. Upcoming data releases matter enormously. JOLTS, ADP employment, and non-farm payrolls will directly influence Fed decisions in coming meetings. Markets are hypersensitive to any labor market signals right now. So what does this mean for tech? Rising yields hit growth stocks through the discount rate mechanism. When the 10-year yield climbs from 3.5 to 4.3%, future cash flows get discounted harder. High-growth tech companies with earnings weighted toward future periods take the biggest valuation hit. This is mathematical, not sentiment. Present value equations don't care about narratives. According to analysis from Calvoot and IG Group, mega-cap names like Alphabet and Amazon are facing renewed scrutiny. These companies still benefit from cloud computing and adoption and AI infrastructure build-out, but they're getting re-rated as the yield environment shifts. The correlation between rising yields and tech underperformance is pronounced. Capital is rotating toward assets offering better risk-adjusted returns in this rate environment. The Nasdaq is experiencing sector rotation as portfolio managers reassess allocations. This isn't broad panic selling, it's selective repositioning. Investors are favoring tech companies with strong current cash flows over those dependent on future growth projections. If your earnings are 5 years out, you're getting hammered. If you're generating cash today, you're holding up better. Julius Baer forecasts a cumulative 50 basis point rate cut in the first half of 2026, contingent on labor market softening. That forecast looks increasingly optimistic given recent Fed hawkishness and sticky inflation prints. Bloomberg and Economic Times analyses suggest the 10-year could settle in a range of 3.75 to 4.25% by year-end. That projection assumes a balance between potential modest cuts and persistent inflationary pressure. Here's the tactical view. The 10-year breach of 4.27 to 4.29% isn't just a technical level. It's a regime change signal. Markets are repricing growth assets relative to risk-free alternatives. Technology investors must adapt to higher discount rates where cash flows are valued differently than in the previous low-yield regime. This adjustment period continues as markets find new equilibrium. Professional money managers are becoming more discriminating within tech. The days of broad sector buying are over. Portfolio construction now demands stronger fundamental analysis, focusing on current profitability, free cash flow generation, and realistic growth assumptions. Companies trading on pure narrative without cash flow support are getting crushed. The bond market is telling us something critical. Long-term rates rising faster than short-term rates, that bear steepening, reflects expectations of sustained inflation and potential economic strength that keeps the Fed on hold longer. This contradicts the soft landing narrative that dominated late 2025. Markets are recalibrating expectations in real time. For traders positioned in high valuation tech, this environment demands tactical adjustments. Consider rotating toward tech names with stronger current earnings, lower price to earnings multiples relative to growth rates, and business models less sensitive to discount rate fluctuations. Defensive sectors and value-oriented equities are seeing renewed interest as the growth trade loses momentum. The Federal Reserve's hawkish communications paired with bond market dynamics create a framework for immediate portfolio decisions. Data from Wedbush and market analysis across multiple sources shows this isn't temporary volatility. It's a structural shift in how growth assets are priced. The Fed holds all the cards, and right now they're signaling patience, not accommodation. Crypto markets are also reacting to this yield environment, though Bitcoin has shown resilience compared to tech equities. Higher real yields make non-yielding assets like crypto relatively less attractive, but institutional flows and macro hedging demand are providing support. Watch the correlation between crypto volatility and 10-year yields. When yields spike, crypto often follows equities lower before diverging based on its own supply-demand dynamics. Sector rotation is broad-based. Energy, financials, and industrials are attracting capital as investors seek exposure to companies that benefit from higher rates or have pricing power in an inflationary environment. Banks particularly benefit from steeper yield curves, improving net interest margins. This rotation isn't complete, suggesting more capital movement ahead. The immediate trading environment favors defensive positioning and selectivity. Technology isn't dead, but indiscriminate tech buying is getting punished. The market is forcing price discovery across growth names that avoided scrutiny during the low-rate era. Companies with stretched valuations and weak fundamentals face continued pressure until yields stabilize or Fed rhetoric shifts. Key data releases over the next 2 weeks will be critical. Labor market reports, inflation prints, and any Fed speaker commentary will move markets significantly. Traders should monitor the 10-year yields behavior around 4.3%. A sustained break higher intensifies tech pressure. A reversal below 4.2% could trigger relief rallies in beaten-down growth names. The current market structure rewards nimble positioning and risk management. Volatility is elevated, creating opportunities for tactical traders, but punishing complacent buy-and-hold strategies in overvalued sectors. Cash is no longer trash when money market funds yield over 4% with zero duration risk. Bottom line, the Fed's hawkish pivot combined with Treasury yields breaking technical resistance has created a new regime for asset pricing. Technology stocks face mathematical headwinds from higher discount rates. Sector rotation favors current cash flow over future growth promises. Adapt portfolio construction to this reality or watch valuations compress further. The bond market is pricing in a higher for longer rate environment. Trade accordingly. That's your market intel for today. Now get out there and trade smart. For more real-time insights, check out capitalcopilot.io.